If you've ever sat down with a life insurance agent or been approached by one, you've probably been pitched something called whole life insurance. Permanent coverage, cash value, an investment component, a product that does more than just insure you. It sounds comprehensive, it sounds like a smart financial move, and depending on your situation, it may be exactly right for you. Or it may be a significantly more expensive product than what your circumstances actually call for. Life insurance itself is genuinely important if you have people who depend on your income. The question, and it's worth understanding clearly, is which type tends to serve which kind of buyer. Today we're going to run the math on both products, lay out who each one tends to serve well, and let you draw your own conclusions. I'm POW. This is the house math. Let's get into it. Life insurance comes in two fundamental forms. The first is called term life insurance. The second is called whole life insurance, also sold under names like universal life, variable life, or permanent life insurance. Let's define both precisely. Term life insurance is coverage for a specific term, typically 10, 20, or 30 years. If you die during the term, your beneficiaries receive the payout. If you outlive the term, the policy expires. No payout, no cash value, no investment component. It's pure insurance, nothing more, nothing less. Many healthy 35-year-old non-smokers can find $500,000 of term life coverage in the range of approximately $25 to $35 per month on a 20-year term, depending on the insurer and underwriting. Whole life insurance is permanent coverage that doesn't expire, as long as premiums are paid. It also accumulates what's called cash value, a savings component built into the policy that can grow over time at a rate that varies by insurer and product. For the same $500,000 in coverage, whole life premiums for a similar buyer can often run significantly higher. In many cases, in the range of $400 to $600 or more per month, depending on the insurer, product, and underwriting. Substantially more per month for the same death benefit. That gap is the starting point for everything that follows. It's worth understanding how agent compensation tends to work across these two products, because it's part of the context for the math. When an agent sells a term life policy, they may earn a commission of roughly 30 to 50% of the first year's premium in many cases. On a $30 per month term policy, that can work out to approximately $9 to $15 in first year commission. When an agent sells a whole life policy, commissions can vary widely by insurer and product, but in many cases may range from 50 to 100% or more of the first year's premium. On a $500 per month whole life policy, that can represent $3,000 to $6,000 or more in first year compensation, with renewal commissions that in many cases can continue for several years. The compensation difference between the two products can be substantial by any measure, which is simply a data point worth having when evaluating the advice you're receiving and the product being recommended. That said, the compensation structure alone doesn't make either product better or worse for your situation. What tends to matter more is the fit between the product and the buyer's actual financial picture. The product that may be more cost-efficient for many common situations tends to generate significantly less commission to sell. The product that may carry higher premiums than many buyers need tends to be among the more lucrative sales in financial services. That's a pattern worth understanding, not a judgment on anyone selling or buying either product. The case for whole life often centers on this point. Yes, premiums are higher, but part of that premium builds cash value. So you're not just buying insurance, you're building a savings component at the same time. That's a legitimate argument. Let's look at what the numbers tend to show. Option A, whole life at $500 per month. Cash value growth rates vary by insurer and policy design, but guaranteed rates have historically tended to fall in the range of 1 to 3%, with potential for higher dividends in some policies. Over 30 years, cash value accumulation might reach somewhere in the range of $150,000 to $200,000, depending heavily on the specific product. Option B, term life at approximately $30 per month. Take the remaining $470 per month and invest it in a low-cost, diversified index fund. At a 7% average annual return over 30 years, a commonly cited long-term historical average, that $470 per month could grow to approximately $567,000. On the same monthly budget, over the same 30 years, the comparison between whole life cash value accumulation and a straightforward index fund investment can differ significantly in many modeled scenarios. It's worth noting that index fund returns are not guaranteed, and traditional whole life cash value comes with a guaranteed floor, which has its own value depending on your risk tolerance and goals. This comparison is one data point. There are situations where the whole life structure serves specific needs that a term policy simply cannot. Let's look at the situations each product tends to serve well. This isn't a prescription, it's a framework. Term life tends to be considered most often when the primary goal is income replacement. If you have dependents who rely on your income, children at home, a mortgage, a partner not currently working, term coverage sized to that exposure can be a cost-efficient way to address it. The need has a defined timeline. Many buyers find that their life insurance need naturally decreases over time as children become financially independent and mortgages get paid down. A term policy can be sized to match that window. Maximum coverage per premium dollar is a priority. For buyers focused on pure protection at the lowest ongoing cost, term tends to offer more coverage per dollar than permanent products. Whole life tends to come up in conversation when estate planning is a factor. For buyers whose estates may exceed federal tax exemption thresholds, whole life can be structured to address estate tax exposure and preserve wealth across generations. This is a well-established use case in financial planning. Business continuity needs are present. Key person coverage and buy-sell agreements sometimes incorporate permanent life insurance as part of a broader business succession structure. Tax-advantaged savings diversification is a goal. For buyers who are already maximizing contributions to more traditional retirement vehicles, 401ks, IRAs, HSAs, and similar accounts, and are looking for additional tax-advantaged accumulation, whole life's cash value component can function as one piece of a broader asset diversification strategy. This is sometimes discussed in the context of high earners who are not yet rich, sometimes called Henrys, who have maximized conventional options and are looking for additional vehicles. Irrevocable life insurance trusts. Sophisticated estate planning structures sometimes use permanent life insurance for specific legal and tax purposes that term coverage cannot serve. These whole life use cases tend to represent a smaller segment of the overall life insurance buying population, most commonly buyers in more complex financial situations. For buyers in earlier or simpler financial stages, families building toward financial independence, with mortgages outstanding and retirement accounts still growing, term coverage is what tends to come up most often as the starting point. Whatever type of coverage turns out to be right for your situation, here's a framework for thinking through the evaluation. Start with your actual exposure. A commonly cited rule of thumb is coverage in the range of 10 to 12 times your annual income, adjusted for outstanding mortgage balance, the number of years until dependents are financially independent, and any existing savings or investments your family could access. Consider the timeline of your need. If you're primarily trying to protect against the financial impact of dying during your working years, the need may naturally decrease over time. If you're building permanent wealth transfer or estate structures, the timeline looks very different. Evaluate where you sit on your overall financial picture. If you haven't yet maximized more conventional retirement vehicles, that's often a different conversation than if you have. The product that makes sense can shift significantly depending on which stage you're in. Get quotes across multiple channels. Term life pricing has become highly competitive. Online comparison platforms let you see a wide range of quotes quickly, which can be a useful starting reference. For whole life and permanent products, working with an advisor who can explain the specific product structure in detail is generally worthwhile given the complexity. If you're evaluating whole life in depth, look closely at the internal rate of return on the cash value, the cost of insurance charges inside the policy, and how the product compares to alternatives in your specific tax situation. Here's where this lands. Life insurance isn't a scam. For people with dependents, it's one of the most genuinely important financial tools available, and one of the most commonly underutilized or undersized protections in most households. The gap between what many people carry and what would actually replace their income is larger than most people realize. The question worth asking isn't just whether to have coverage, it's whether the type and amount of coverage you carry is actually matched to what you're trying to protect. For many buyers, that evaluation points toward term, as direct, cost-efficient, and size to the most common need. For others, particularly those in more complex financial situations, permanent products can serve purposes that term simply cannot. The numbers for a straightforward buy term and invest the difference comparison have historically tended to favor the term plus index approach in many modeled scenarios, though historical returns are not guaranteed, and the right answer genuinely depends on what you're trying to accomplish. Life insurance is a large category with a wide range of products, structures, and use cases. The most useful thing you can take from this video is simply a clearer picture of what the math looks like, so that whatever conversation you have next, whether with an agent, an advisor, or online, you're walking in with the numbers already in hand. Now you have them. Next video, we look at what your 401k may be costing you in fees, and how a seemingly small difference in expense ratio can potentially compound into a six-figure number over a career. Subscribe so you don't miss it. I'm POW. This is the House Math. See you next week.